Good afternoon. Thanks for joining us today for our cannabis market update featuring Charles Taerk of Faircourt Asset Management, sub-advisor to the Ninepoint Alternative Health Fund. My name is Howard Almdahl and I'm your wholesaler based in Winnipeg. Charles and my business partner Dan DeCruz are on the line at our head office in Toronto. It goes without saying that the cannabis market is a huge investment opportunity, with one estimate stating that legal cannabis sales will reach $57 billion by 2027. Charles takes a unique approach to managing risk in the fund, which he will discuss shortly. Charles has been president and CEO of Faircourt since its inception in 2002. Prior to that, he was vice president and managing director for Charles Schwab Canada. All of your lines are muted. You can follow along with the presentation and ask questions online. I'll now turn it over to Charles.
Thanks very much, Howard, and welcome everyone. Really appreciate you spending some time with us today. I'm going to go through the presentation, and I understand there's an ability to ask questions, to type out questions, and hopefully we can get to those a little later. So I wanted to just go through. We're going to start on, I think, slide 4 or 5 here. There we go, just getting my mouse organized. The first couple of slides are an overview of Ninepoint, but we're going to go to the, there we go. So first, let's just have some background knowledge. And as Howard said, there's some explosive growth behind the cannabis sector right now. And it's not just growing in Canada, it's global growth, certainly in North America, but around the world. 2.5 years ago, when we launched the fund, there were only about 10 or 15 countries that were legal for some form of medical marijuana. There's now over 40 countries, and that number continues to grow. And we really see that that's the long-term growth associated with it. Some people don't believe in the short-term prognostication of where Canada is going to be. But certainly, when you look at the global opportunities, this is in the early stages. I like to use, it's the second inning of a baseball game, and there's a lot of growth still to be achieved for some of the early participants. On our next slide, when we look at domestic market potential, I like to use this graphic because it really shows two things. Number one, it shows the short-term market opportunity in Canada, but it also shows some of the most recent strategic investors who have come into the sector, and we'll talk a little bit about why. Whether you believe CIBC's estimates that the Canadian market can be $6 billion in the next couple of years, or Deloitte's at $3 to $5 billion by 2020, we have explosive growth because last year was only about $1 billion. So there's a significant amount of growth in the short term, and that's what's driving some of the valuations and some of the names. But when we look closely, you can see on this chart the black market, which is on the far side, far right. It's anywhere from $8 to $10 billion in Canada. And what the federal and provincial governments have wanted to do is legalize this illicit activity, charge some tax revenue, and what we're also getting is a significant amount of employment. And we're getting employment both in the agricultural sector, in the retail sector, in the distribution sector. So there's many wins from an economic standpoint. But you're also getting new participants into the sector. You see the tobacco, the beer, the wine, the spirits companies showing their relative market size in Canada. And none of them equate to the size of the illicit cannabis industry. So it's no surprise, why these companies want to get involved in cannabis, both from a market size perspective, but also they're losing market share. In the US, where we've seen recreational marijuana come into play in the last 6 or 7 years, there has been a significant drop in the demand for alcohol. Consumption is down anywhere from 10 to 15% in those states that brought in recreational marijuana. And that's despite the fact that the tax rate, the recreational marijuana tax rate in those states is almost double the tax rate for alcohol. So you're seeing that despite the regulatory environment, or despite the tax regime, that the demand for cannabis products is booming. And that's why the alcohol companies are getting involved. They see a drop in their revenue and they want to be part of the growth. They want to recapture part of their market. But equally as important, and I think driving the global market, is what we talked about on the next slide, which is cannabis as an alternative treatment. And really, this is what's driving the global growth, or what we believe is the long-term value in these cannabis companies. There are studies throughout the United States, Europe, and Canada that are looking at the efficacy of marijuana. And when we talk about marijuana, we're talking about two primary compounds. There are 140 subdivided chemical compounds in a cannabis plant, but the two primary ones are THC, which gives everybody the psychoactive effect, it makes you stoned, and then there's CBD, which really has no psychoactive effect. But through research over the last 15 years, it's been discovered that CBD has a lot of benefits. And we're finding out through clinical trials that CBD, not only does it have no psychoactive, but it's an anti-inflammatory and it's an anti-seizure medication. And there was a major breakthrough last year, which is really driving the medical innovation, the science in this sector. A company called GW Pharma last year was the first company to gain FDA approval for its drug. It's called Epidiolex. And Epidiolex treats certain types of childhood onset of epilepsy. So CBD is an anti-seizure, and it's been used anecdotally for years in the US, and it's been featured in magazines and TV for years, but finally the FDA approved it unanimously last June. Why is that a significant breakthrough? Not just for the company that discovered this product, but also for the entire industry and the global medical marijuana industry. So number one, it's the first botanical cannabis drug to be approved by the FDA. That's significant in and of itself. But second, to be approved, CBD has now been carved out of the Controlled Substances Act in the United States, a law that's been on the books since the early 1970s. And so that's a major breakthrough, because the Controlled Substances Act states that marijuana basically has no medicinal value. So by the FDA approving Epidiolex, it's having to both eat crow and change its law at the same time. What it's telling people in the medical marijuana field, and more focused those that are in the scientific area, is that continue to do your clinical trials. The FDA is open to review your research and to approve new drugs. That's probably the most significant aspect to what's going to drive value. Because once the FDA approves drugs, if we look at the pharmaceutical industry, the pharma companies spend millions, if not hundreds of millions of dollars, developing and approving drugs. And once the FDA or Health Canada approve that drug, it then gets patent protection for a number of years, and it gets what's called a DIN, or a drug identification number. That DIN protects this patent for a number of years. With the case of Epidiolex, it's now available in all 50 states as a medically approved drug. And the doctors now can see the efficacy behind this medication and have begun prescribing Epidiolex for patients who suffer from seizures caused through epilepsy. As I said, it's available in all 50 states, not just the 32 that are medically focused in the United States. And it qualifies for Medicare and insurance coverage in the United States, which is significant. No other cannabis medication is qualified. So successful clinical trials are on the way. There are more drugs in stage 3 or phase 3 clinical trials, and we continue to see more opportunities long-term in the global medical front. And that's really where we believe the long-term value is. The small chart in the bottom, which shows the growth in patients, is a Canadian chart. And although the chart only goes to last fall, it shows that the number of patients has grown significantly. Health Canada doesn't provide this information anymore, which is why the information is dated. But basically, we went from June of 2014 of less than 10,000 patients to well over 350,000 patients in 5 years. So that's at a time when doctors were reticent to prescribe. Think of how many patients can be treated with medical marijuana once doctors are more comfortable when they're seeing the efficacy of what the FDA and Health Canada will soon be approving. So that's where we believe the big opportunity is. Another big opportunity for Canada is on the next slide. And I'm sure people in Saskatchewan on the line are well aware that Canada is the second largest cultivator of hemp from around the world. And what we're seeing is outdoor cultivation, greenhouse cultivation is going to be a significant business for the foreseeable future in Canada, both to build scale and then to extract oil to create some of these medical products and health and wellness products. CBD is generated from hemp, and hemp is a cheaper form of a cannabis plant. It's easier to grow, and as I said, Canada is abundant in its ability to grow. We see great opportunities, not just for cannabis companies in Canada, but for hemp-based CBD companies. And you'll see in our portfolio that we own CBD as well as THC-focused businesses. When we look at the US, I mentioned the hemp-derived CBD. And in the United States, the Farm Bill of 2018 really changed where the investment opportunity is in the United States. The Farm Bill was approved in December, and it basically approved the production, cultivation of hemp-derived CBD. And this was approved, brought to the floor of the Senate by Mitch McConnell, who's a Republican, but he's in Kentucky, and he's all about supporting farmers. And so the Farm Bill has really set the Canadian market apart from the US, because the US is now taking the brands and products that were previously confined to the dispensary networks, and they're bringing them to a wider audience. And this is where we believe more market opportunity exists in the US. It's why our portfolio has been more focused in US names this year. Cannabis companies have created health and wellness brands that are CBD focused, and they're taking their brands to all kinds of malls across the United States, to stores that we all shop in, whether it's Albertsons and Safeway, or it's Whole Foods or Walmart. You're going to see CBD brands in major retailers in the United States, whereas in Canada, CBD products are still confined to the dispensary network. So again, we look at Canada and the US very differently, both for CBD and THC, but we believe that the CBD market is a very significant opportunity to exploit this year and in future years. The map is colored in different shades of green to show you the different states that are approved for recreational, which are the lighter green, and the medical states are light green, the dark green are the recreational states. And what's important about the dark green states is you're going to start to see more of them pop up across the US. The state of Illinois and the state of Michigan have both gone recreational. And what it means is those dispensaries that previously catered only to patients are now available to exploit the recreational markets in those states. Case in point, Illinois approved recreational marijuana at the end of at the end of May. And what they've done is they've given the initial or the incumbent dispensaries a head start in building out more dispensaries. So two of the Illinois-based companies, Cresco and Green Thumb Industries, both of which are in our top 10, both are leading dispensaries in the state of Illinois and get to double their footprint within the state, going from 5 dispensaries each to 10 dispensaries each within the state. And Illinois is a large state, and it's going to be significant revenue additions for those companies. New York is being debated right now. It probably will not be approved this year, but come 2020, we expect New York State also to go rec. This isn't because governors are getting lax on drugs. This is all about tax revenue. The recreational market is generating significant tax revenue already, and governors are realizing that a quick way to balance budgets is to tax and legalize marijuana. One interesting anecdote, the state of Colorado in 2018 has generated more tax revenue from cannabis sales than it has from alcohol sales. They've now collected over $1 billion in tax revenue related to cannabis. And Colorado is 1/6 the size of Canada. So now you can understand why the federal government is so focused on bringing recreational legislation to our country. On the next slide, the very colorful map of the US. This is a different aspect to the United States and a different aspect to how the medical market is going to unfold. And when the pharmaceutical companies start to pay more attention to what's going on in the cannabis sector. Currently, there's about 25% of all adults in the United States suffer from chronic pain. It's a very large qualifying condition, and in many states, cannabis is a treatment for qualifying chronic pain conditions. This map shows that the number of painkillers per 100 people is completely out of whack in the United States. You probably know the names, whether it's fentanyl, Oxycontin, Percocets, and I'm sure there are many others. Americans are tied to their painkillers. They're highly addictive and they cause inadvertent overdose. And you've heard about the opiate crisis and you've seen the pharmaceutical companies go in front of Congress. Medical marijuana has been found to be safer, less addictive, and it's cheaper to administer. The state of Illinois brought in legislation last year that New York, Ohio, and Pennsylvania are all bringing in and embracing as well, which is opiate replacement therapy laws. They basically want people who have a valid prescription for opiates to get off opiates. Typically, there's a 90-day window where if you apply for a medical marijuana card in any of those states, that they do a background check. If you have a valid opiate prescription, you're switched in 1 day because they want you to get off these terrible painkillers. And it's worth hundreds of millions of dollars in each of those states to the benefit of the marijuana companies. So this is where we believe, I mean, we've seen Epidiolex, and now we're seeing it in chronic pain. This is where we believe the pharmaceutical companies are going to begin to take more note and begin to look at investing in the sector. So what do the Canadian companies have? We're on slide 12 as we're following along. The Canadian companies, you know, they're 4 or 5 years old, maybe 6 years old. They're new, they're growing, but they've learned how to grow to scale. And that scale is what they're taking around the world. I mentioned before, there's now 40 countries that have some form of legalization, but it's not easy enough for Canada to just export out of Canada. Canadian companies are building locations in other jurisdictions, both where it's more efficient to grow, as well as where it's going to be more effective to grow. There are going to be countries that set up barriers and want their own domestic industries. And so Canada is creating joint ventures in those countries, whether it's Germany, Denmark, Australia, Colombia, various countries in Latin America, where it's both cost effective and helping with building a global network. That's what Canada has. We have first mover advantage as we are legal nationally. The US companies cannot do that. And so the faster the Canadian companies can build their international networks, the better they will be when it is time to be negotiating M&A transactions with large pharmaceutical companies and large US CPG companies. That's going to be the goal. We already have innovation in our country, and this is what's driving some of the margins. So it's not just about smokable product, it's not just about agriculture. And in fact, we would suggest that many of the companies that we own are less about agriculture and more about products, value-added products that are going to provide higher margin than simply growing dried bud. And Canada's been at the forefront, whether it's creating soft gels or sublingual mists or topical creams. All these products are higher value and higher margin products than simply selling dried bud. And so we tend to focus on those companies that have technology, have innovation, and have the ability to get their products distributed to market. So I mentioned the 40 countries. And what we've done here is taken the map of several areas that are very important to the Canadian LPs. And we've given you the stock symbols of the various Canadian companies that are operating in these different jurisdictions. As you can see, Europe is very important. There's 740 million people in Europe. Germany is obviously most important. It was the first country to legalize in Europe. And Germany is really driving the bus here. What's important is that in Europe, insurance covers the cost of medical marijuana. They're not doing it in Canada yet, but it's important to drive the business in Europe because Europe is still 4 or 5 years behind us. You're starting to see European sales creep up in the quarterly revenues of some of the LPs. There are about 10 LPs that are selling into Europe. I would say Aurora, Afria, and Canopy probably have the most in terms of exposure, in terms of direct sales right now. And as you can see, the other areas of the world, South America, Australia, and what companies are looking for isn't just large populations, but they're looking for more efficient production. So if you think about the equator and you think about temperate climates, you think about lots of sun 12 months of the year, you think about cheaper labor than we have in Canada, and that's where some of the export and distribution is being driven. So there are a lot of catalysts going on in this sector around the world. And the most important thing that I think active management brings to this portfolio is there's a lot of activity. Every day there are press releases. Every day there's a new announcement, whether it's a financing, quarterly results, interviews with management. We visit facilities. You can't just invest based on press releases. And so our biggest, most important differentiator is we're doing due diligence for your clients. We are doing the due diligence and we're reducing volatility and reducing risk of making an investment in the cannabis sector. Last year, there were 3 different periods where the cannabis sector, the index, was up more than 25%, and 3 different times when the index was down more than 30%. It requires active management. You can't just pick a name and go for a ride. And what we do is we trade our names. We might like them a lot, but if they go up 30 or 40% in 2 weeks, we're taking profit. We're going to go to cash at times. We use option writing to help reduce and mitigate the volatility. But what we're doing is we're generating the best risk-adjusted returns in the country. We believe that we've got very sound policy when it comes to our investments. And what we're able to do is generate solid returns, reducing risk. Last year, if you had just invested in a passive strategy like the HMMJ, for 2018, it was down 18 or 19%. Our portfolio was up 18%. That's a big difference. That's what active management generates. So at a time when there is lots of catalysts and a lot of M&A going on, we believe that due diligence and active management is critical to reduce risk while providing opportunities for capital growth. That's really the most important message that I want to leave you with. I want to go to a couple more slides just to talk a little bit about our portfolio before we answer some questions. Many people have asked us recently why we like US names over Canadian licensed producers. These two slides are really important in addressing two different aspects of why we like the US. Number one, the US market is larger than the Canadian market. We're 37 million people in Canada, and quite honestly, we don't have a lot of dispensaries. And people are learning fairly naively. We need to learn and understand about cannabis. We need to learn and understand about the products. And without dispensaries, without being able to go into a store and ask somebody for help, people aren't learning online. So we believe that Canada is far behind. Even though we were first in legalizing, we're far behind in our rollout. We need more dispensaries before people get educated. In the US, there's very developed dispensary networks. Within the 33 states that are legal for medical purposes and rec, it's a large addressable market. It's about 180 million people with brands that have been developed over the last 5 or 6 years. I mean, anything in the branding business, whether it's drinks or clothing or cannabis, brands are developed in New York and Los Angeles, and the cannabis sector is no different. The largest cannabis sector or cannabis industry in the world is in California. And the US is well ahead of us in building brands and building loyalty. If you think about what consumers buy and how we buy things based on brand awareness and brand loyalty. In Canada, we don't have that yet. People are buying based on THC content or CBD content, but they wouldn't know whether they're buying a CannTrust product, an Aurora product, unless they're very knowledgeable. And so we believe that the US market is very well developed, is larger, and has developed brands. But what this chart shows is that they're trading at a significant discount to the Canadians. So the Canadians are the red line, the black dotted line are US multi-state operators. And on average, the Canadian focused names trade at about 35. Well, this is 35. It's actually 38 times as of today, 38 times 2020 earnings, whereas US companies are trading at about 11 times. Why that's important is that we don't want to buy at 38 times earnings when we're in a significant growth phase. We're looking to buy companies that are undervalued, that we see great opportunities to grow with, and that's where we see the US market. Stronger cash flows in the US, better brand development, and a larger addressable market. And I think the next slide really just drives home another orientation of the US market. These brands are not in the cannabis sector, but what the pyramid shows is different companies, different brands in different areas of production. So you've got companies that are involved in agriculture and steel. They're in inputs, versus at the top of the food chain, you've got brands. And if you take a close look, when you see the gross margin and EBITDA margin of brands or wholesalers and distributors versus undifferentiated input providers, you will see where the focus is for us. We're looking for those companies that own valuable brands, because the margins from those companies is double, triple, quadruple the size and value of undifferentiated inputs. What do we mean by undifferentiated inputs? We're talking about plants. Is it more valuable to be the cultivator of plants, or is it more valuable to be the distributor or the owner of brands? And that's where we see the US companies providing better value, higher margins, and less capital allocated to the agricultural side of the business. And so that's where we believe we've oriented our portfolio to higher margin, better value. I had mentioned this before in 2018. This is just a schematic of the peak to trough performance of our fund versus HMMJ. And we already talked about the fact that we finished the year off basically at, I think, plus 18, and they were down 19. But that's what it looked like from a peak to trough performance. We are not going to give you 100% of the upside, but what we are giving you is less than half the downside. And that's probably the most important aspect to this. If we go to this next slide, well, you'll see downside deviation and standard deviation. That's less volatility, less than half the volatility of the marijuana index, and actually even less volatility than the healthcare index. So really important that not just that we're generating solid annualized returns, but we're giving you annualized returns with less risk and less vol. So with that, I'm going to pass it back to Howard and see if we can answer some questions.
Thanks, Charles. I think you'll have some questions there online that Dan can help you with.
I got a couple here. Well, the first one interesting is what's the status of federal legalization in the US? There's been quite a debate as to whether the presidential nominees are all in favor and whether they're going to win the presidency that way. I don't personally, after speaking to a lot of American companies, we don't think that the US will legalize on a national scale. We believe that what will more likely happen is that something called the States Act is brought into law in Congress. And the States Act is basically a federal law that protects state-run legal cannabis businesses. And so the federal government will not have to step in and create rules governing a national cannabis industry, but it'll stay similar to the format that is created right now with multi-state operators. It protects incumbents, which is good for the companies that we've invested in. But what it also does is it protects the federal government from having to create a layer of regulatory that the federal government does not want to create. Discussing the advantages of our fund versus HMMJ. So there's many. Number one, we mentioned it a couple times, we are an actively managed fund. HMMJ is a passive fund. And so HMMJ will only add companies once a quarter, which is calendar run, the third Thursday of the calendar quarter month end. So, March, June, September, December, they'll add companies. And they let those companies run through the quarter, and then they rebalance them after the next quarter. It penalizes the winners, because if a company grows over its maximum weight, it gets cut back. And so that's kind of a detriment to owning HMMJ. It's passive. It also does not participate in new issues or IPOs. It doesn't own any private companies, and it can't go to cash. And I think that's really important because this is an early stage sector. It's quite volatile, as we showed on that chart. There are going to be times where active management is required, where you're going to want to go to cash, where you're going to want to reallocate to new names. and HMMJ does not give you the opportunity to do that. We also own private companies in our portfolio. The mutual fund can own up to 10% in private companies, and we own currently up to about 7% of our fund is in privates, largely US companies that provide services into the cannabis industry. And finally, we write options. Options, I mentioned earlier, lower the risk, lower the volatility of our underlying portfolio. They also help us get advantageous positions as we're buying in because we use put writing. So we're throwing a lot of tools at this fund versus just being passive. We think that given the early stage nature of this sector, you can't afford to be passive. You must have an active manager who's watching the sector, doing the research. So here's an interesting question. Is it too late? So a lot of questions about valuations, and I touched on it a little bit before. Not all companies are created equally. A lot of people think that the Canadian LPs or North American LPs are a homogenous group, and they're not. Just to give you some average stats. So Canadian LPs trade at 36 times earnings. The select Canadian companies that trade on NASDAQ in New York, they actually trade at 55 times earnings. So really high growth multiples. The US companies trade at 11 times. So when you're talking about putting together a portfolio, do you want to own the most volatile names that are trading at 55 times? Or do you want to own ones that are a mix where you can own the best names and aren't necessarily only owning the highest volatility names? I think it's really important from a portfolio construction standpoint to do the work, look at the valuations, and then decide which companies may be worth it and which companies aren't. So as an example, Tilray is one that we owned for about 5 weeks last year. It was an IPO at $17 back at the end of July. And by the beginning of September, we sold it at $92. We haven't owned it since, but it still trades at around 90 times earnings, even though it's not trading at $300 anymore. It trades at $30 or $40. So great company, good management team, but trades way ahead of itself. So that's the type of work that we do. We don't pick all companies. We don't believe all companies are created the same. Interesting question about the US. Talk about owning stocks. So yeah, so this is a question about people crossing the border. There's actually a piece of legislation in Congress right now. It's called the MAPLE Act. Obviously, maple is something we all know and love, and it's a congressional bill that's been put together to reduce the sensitivity of Canadians traveling across the border. All for vacations. This isn't about Canadians going to work in the cannabis sector in the US. This is about snowbirds going to Arizona or Florida, or people going to Disney World. And Homeland Security wants to reduce the risk or the perceived risk of Canadians traveling across the border. Essentially, if you own a mutual fund, you don't have to disclose that you own any cannabis companies. You own mutual funds. Secondly, if you only own Canadian companies, US Homeland Security does not care. It's the extent to which you're involved in US companies that they're more afraid of, more sensitive to. And so by and large, Canadian travelers should be comfortable traveling across the border, as long as you're not traveling under the influence, whether that's alcohol or marijuana. But that law has been on the books forever. Have time for one more? One more. Yeah. So somebody asked a question about Green Thumb Industries. So Green Thumb is in our top 10. And yeah, recently, well, during the month of May, the entire sector was down significantly. I think the index, the HMMJ, was down about 15% during the month of May. We were down about 6%. Green Thumb Industries is an Illinois-based multi-state operator. It's in 11 states. It is licensed for 95 dispensaries amongst those 11 states. Right now it has 23 storefronts open. In Illinois, its products aren't just sold in its own dispensaries, but it's sold in 100% of all dispensaries in the state of Illinois. So it's a very interesting business because it owns bricks and mortar. It owns brands as well that get sold in other people's dispensaries. It recently has expanded out to Nevada and California, and it's a company that we see continued growth from, given the number of licensed dispensaries that it has on its books. As I said, going to 95 by the end of this year. Okay, and with that, I'm going to pass it back to Howard for some final comments.
Awesome, Charles. Thank you very much. Thank you all for taking the time to join us today. We'll be sending out the presentation that Charles gave and the fund codes to you shortly, and we'll follow up in the coming days. In the meantime, please give Dan or myself a shout if we can help, and have a great rest of your day.